Hello and welcome to this overview of the Series 7 exam brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over the investment companies section of the Series 7 exam, starting with a packaged product. And what this is a pool of investments that put together lots of different holdings that is professionally managed. These are defined and regulated by the Investment Company Act of 1940, which I'll refer to as the Act going forward. The Act specifies these three types of investment companies. First, management companies, which contains mutual funds, which we're most familiar with, unit investment trusts, and face amount certificate companies, which are much less common. A management company can be an open-end or mutual fund, which uses a net asset value or NAV calculated at the end of each trading day to determine the price at which you can buy or sell shares in the fund. A closed-end fund offers all of their shares at the beginning, and then these shares can be traded on the open market, and that determines your market value in the fund. A unit investment trust is a percent or partial ownership of this pool of fixed investments which doesn't change during the life of the unit investment trust. There's a fixed end date at which you redeem the shares, and as well as the holdings do, that's your return on the investments. These are units are sold for $1,000, but you only get $950 of value. 5% gets taken away by a sales charge. A face amount certificate company is an investment made in a fixed final payment that is known ahead of time. So the interest rate and the future amount are all preset. You can purchase these through an installment payment or lump sum payments, and you can redeem ahead of time through a specified surrender value. To be defined as a diversified management company under the Act, 75% or more of your assets have to be invested. So you can't have more than that sitting around in cash or cash equivalent securities if that's not the focus of the investments. And to be considered diversified, you have to have 5% or less invested in any one company and have 10% or less of the voting stock of any one company. There's many different kinds of mutual fund types. Here's some of the main ones, starting with growth, bond funds, and equity funds, as well as index funds, international funds, and money market funds. And we'll go through some of these right now. Growth fund is looking at high risk, high return areas. So common stocks in companies that have been experiencing strong growth, and we're looking at mainly capital appreciation. So not investments or stocks that are throwing off a lot of dividends. In an equity income fund, we're looking at the other side of the equation from the growth. We're looking at common and preferred shares that are paying out high dividends. These are generally lower risk, cash cow kind of companies that are more mature than our growth type of companies. In a bond fund, we're switching over to the debt type of investments, and these can include anything from treasury securities through mortgage bonds or corporate bonds. An index fund, in its objective, risk profile, and time horizon, is trying to replicate the results of some type of index. Some of the main ones are an S&P 500, Dow Jones indexes, or the Russell 2000. But they're just trying to get the same risk return profile as whatever index they're set up for. An asset allocation fund is similar to a balanced fund in that it has a range of asset classes such as stocks, bonds, or cash equivalents that they can invest in, but they're not tied to maintaining a balance. So if their market view is for strong growth, they can move all of the investment towards common stocks, or bonds or any combination. So it's much more flexible and just depends on the portfolio manager's view on what's going to be profitable coming up in the future. We have specialized or sector funds. So these are investments that are focused on a specific area, let's say biotechnology. So these are typically a higher risk because they're less diversified, but allows investors to get exposure to certain parts of the markets in their overall holdings. And also we have international funds, which are non-US securities. These are typically higher risk, higher return type of investments and money market mutual funds, which are investing in cash equivalents. We're looking at much lower risk investments and lower returns, but with investors who are looking to maintain their liquidity and have a low risk profile. A holder is an investment in a basket of securities which is fixed after it's set up. So there's no management fees and minimal transaction and custodian fees because there's just not a lot going on. These can be traded on an exchange, so that provides liquidity. You can sell out of the investment uh, relatively easily, and you can get some price transparency on this investment as well. An ETF is a very large part of the market these days. It's a basket of securities, and the benefits are that it doesn't have any loads and very low expenses compared to a mutual fund. They're also more tax efficient than mutual funds as well, since their setup is mainly based on exchanging securities rather than buying and selling. It doesn't trigger a taxable event, so it lowers the expenses for the fund and the investors. And these can be traded like a stock, so they can be bought on margin, they can be sold short, and they get pricing as they're trading throughout the day, which is unlike a mutual fund, which only has a price one time at the end of the trading day through its NAV. So a lot of advantages to an exchange traded fund. An expense ratio is the amount that costs to run the mutual fund or investment fund. These include the investment manager fees, all the record keeping, legal, tax reporting for the investors. The total expense ratio does have to be disclosed in the prospectus, and it's calculated simply by taking the total expenses and dividing by the average net assets to get your expense ratio. And that makes it easy to compare the expense ratios of different mutual funds and is a consideration when you're looking to invest. All of the funds require a board of directors, which must be a majority independent. And what they do is establish all the top line guidelines for the fund, the investment policy. They appoint the different vendors, such as the investment advisors and custodian banks. And they set up the main policies around dividends and capital, as well as for 12b1 fees. Custodian bank is the holder of the cash and securities of the portfolio for the asset manager. And what this provides is a segregation of duties function between the portfolio manager and the holdings of the investors. So they maintain very good records of what's going on with the holdings. They safeguard the securities and cash. And as the holder of the securities, they collect the dividends and interest payments for all of the investments. There's also a transfer agent who maintains the records for the bond issuer or the shares of the company for a corporation. They distribute the dividends and the capital gains for those types of securities. They also keep customer records of who's holding those shares or the bonds and provide all the servicing, all the back end reporting, as well as administration, such as providing mailings to shareholders. And the NAV, the all important NAV for our mutual funds, the net asset value, is calculated daily at the end of the trading day after the market close. And it's simply a calculation of the total assets divided by the outstanding shares. That gives you your NAV per share, which is telling you the price that you can buy or sell into the mutual fund on any given day. There's 12B1 fees, which we mentioned before, and these are the distribution and marketing costs for the mutual fund. There's a maximum of 1%, and fees generally range between a quarter of a percent up to that maximum. There's different types of charges that are defined in these mutual fund classes. There's a Class A or front load. You pay your sales charge when you buy the shares. Class B or back end load. You pay the sales charge when you sell the shares, but these can be waived if you hold the shares for a long enough time in some cases. We also have Class C mutual funds, which has a shorter holding period. And then finally, no load mutual funds, which may charge a redemption fee, but they have lower 12B1 fees set to a max of 0.25%. Sales charges are charged by distributors of the mutual funds, and they're limited to a max of 8.5% of the public offering price. It's calculated as the fee divided by the public offering price. So in our example here, we have a $10 price that we've paid for our mutual fund, but we only get $9.75 of value in the mutual fund. And that means we've paid a sales charge of 2.5%. Taxes on mutual funds work very similar to the securities that they're holding. In any case, short-term gains are taxed as ordinary income, and you have to hold the shares for a year or longer to get the benefits of a long-term capital gains rate, which is usually much less than the short-term rate. And finally, just a note on REITs or real estate investment trusts. These can be customized and sold privately between investors, or they can be set up as shares that can be sold on an exchange. There's two main types, equity REITs. These invest directly in ownership of the real estate, commercial or apartment buildings, versus mortgage REITs, which invest in the mortgage debt behind real estate investments. That's it for our investment company overview. If you have any questions, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.